All right, so one of the most common questions I seem to get is this. Why do mortgage rates change so much? Sometimes they're up, sometimes they're down, and if you're a potential buyer or seller, it can feel pretty random. But the truth is, there are real reasons behind why mortgage rates fluctuate so often. And today, I'm breaking down why mortgage rates fluctuate up and down in a simple, non-technical way. Number one, the economy. Simply put, mortgage rates are closely tied to how the economy is performing. When the economy is strong, meaning jobs are growing and people are spending money, mortgage rates tend to rise. And when the economy slows down or there's uncertainty, mortgage rates often drop to encourage borrowing or spending. Number two, inflation. Inflation plays a huge role in mortgage rates. When prices rise quickly, lenders raise rates to protect the value of their money over time. When inflation cools down, interest rates usually follow. This is one of the biggest drivers of mortgage rate changes. Number three, the Federal Reserve. The Federal Reserve doesn't set mortgage rates directly, but its actions heavily influence them. When the Federal Reserve raises or lowers interest rates to fight inflation or stimulate the economy, mortgage rates often move in the same direction. Number four, the bond market. Now, this one might surprise some people, but mortgage rates are closely tied to the bond market, especially the 10-year Treasury bond. When investors feel confident, they move money into stocks, and interest rates tend to rise. When investors seek safety, they buy bonds, which often push mortgage rates down. Number five, supply and demand for loans. Just like anything else, supply and demand matters. When people are applying for mortgages, lenders may raise their rates slightly. When demand slows down, lenders often lower their rates to attract more buyers. Number six, global events. Events around the world like wars, elections, financial crises, or major economic shifts can impact mortgage rates. Uncertainty tends to push rates down as investors look for safer places to put their money, while stability can lead to higher mortgage rates. Number seven, your personal financial profile. While the market factors drive the overall mortgage rate trend, believe it or not, your credit score, your down payment, your loan type, and your debt to income ratio affect the specific rate you're being offered. I've seen crazy things like when I had two buyers, they both applied for the same loan on the same day with the same lender at the same lending institution, but each got different rates because each buyer had a different financial profile. The bottom line is this: mortgage rates aren't random. They move based on economic conditions, inflation, market confidence, and global events. That's why mortgage rates can change daily, sometimes even hourly. Just remember, you can't control the market, but you can control your preparation. Understanding how mortgage rates work helps you make smarter decisions when buying or refinancing. If you have any questions about today's mortgage rates or want to know how they affect your buying power, I'm always happy to help. Reach out anytime. Catch you guys next time.